All right, I think the big question for everybody right now is how important is this CPI report really? Also, when we're looking at the numbers, core and headline, which one is more important to the Fed? Big divergence when we're looking at core, which is higher than headline, which seems more in line with the Fed's goals.
Well, of course, let's just start with the easier one, which is that the Fed tends to focus on the inflation rate, the core, excluding food and energy, which people, often wonder, why do they do that? We spend so much of our income on food and energy. They just tend to be more volatile, moving up or down, given, as you talked about, Middle East tensions can move those numbers around. And the Fed is trying to get a better gauge of underlying inflation. So they tend to exclude those more volatile categories and look at the core. And that is where I think we'll see the risk of some firmer numbers. And I say, Frank, it is important. Remember last Friday we had a blowout, if you will, employment report, surprising everybody. Every aspect of that jobs report was strong. And it led to a significant recalibration in the market about what the Fed was likely to do in November and beyond in terms of continuing to lower interest rates. And so you saw expectations scaled back dramatically from thinking we would see another 50 basis point rate cut in November to now not even fully pricing in a 25 basis point cut. So this morning's numbers could really further that expectation of less rather than more from the Fed.
One other thing I want to ask you about, obviously in the news today, the hurricane. Does that impact the Fed's thinking at all? The general consensus is it'll skew some of the economic reports that we have coming up.
Well, the Fed will look through any temporary distortions to the data. So whenever we see hurricanes that can impact the numbers, even sometimes when we see things like workers' stoppages or strikes, those temporary factors are not really what the Fed is going to put a whole lot of weight on because, again, they're trying to look at longer-term trends. Monetary policy obviously impacts the economy with a lag. And, of course, they're focused on sort of the underlying fundamentals rather than short-term movements in data.
Michelle, you're hitting on some recent news, the port strike and the eventual deal on wages, at least the tentative deal. We know that the wages for those longshoremen is going to go up over 60%. You describe wage inflation or those job actions as temporary, but the wages going to continue to move forward. Is the Fed at all worried about wage inflation? Is that something that they're factoring in their decision when it comes to November or possibly December or the rest of 2025?
Well, they certainly watch wages because they believe that wages is an important indicator of future inflation. I think it's important to remember that the number of a percentage of workers affiliated with unions is relatively small, about 10% of all workers. And in fact, their earnings have sort of lagged non-union workers. So the big gains we're seeing here actually go against what is more recently a general downtrend in wage inflation. As the labor market has cooled more broadly, we're actually seeing some downward pressure on wage inflation. I think that's the trend that is going to be more front and center in the Fed's mind. And again, is one of the reasons why, despite these large wage settlements in terms of unions, you're still seeing the Fed saying they're comfortable about the outlook for continued disinflation.